SwayamPrabha. Digital India. Educated India.
Hello everyone, welcome to today's lecture on theories of real estate pricing and market efficiency for the course Real Estate Finance and Investment Strategies. First, the learning objectives of this particular class. Understand the fundamental theories of real estate pricing. Analyze market efficiency, concepts in real estate context with the focus on India. Evaluate the efficient market hypothesis, application to real estate. Identify factors contributing to price stickiness in the Indian real estate market. Recognize characteristics and causes of speculative bubbles and apply theoretical frameworks to real world Indian real estate scenarios. So, let's start. First, what is the real estate market efficiency? So, market efficiency in real estate refers to how well property prices reflect the true value of the underlying assets. Think of it as a measure of how smart the market is. The four key characteristics you should remember. First, information integration. This means that when new information becomes available, it should quickly be reflected in property prices. For example, when the Mumbai Metro announced new lines, property prices along those routes should theoretically adjust immediately. Then we have second one, which is price discovery. So, the market should act as mechanism to reveal what properties are actually worth, not just what seller hopes they are worth. And the third is resource allocation. Efficient markets direct capital to where it can generate the highest return. In real estate, this means money flow to the most productive location and uses. And then we have transaction cost. These significantly impact efficiency, and in India with stamp duties ranging from 5 to 10%, these costs can be substantial barrier to efficient price discovery. Then we go to the importance of pricing theories in real estate. So now, why should you care about these theories? They are not just academic exercise, they have real world application that directly impact your career prospects and the investor decisions. From an academic perspective, understanding these theories help you recognize the patterns in market behavior. You will be able to develop predictive models and spot investment opportunities that other might miss. But more importantly, from a practical standpoint, these theories guide investment decisions. So, when you are working with a real estate fund or making personal investment choices, understanding how market price assets help you make better portfolio allocation decisions. For risk assessment, these theories help you to understand market timing and volatility. And for the policy formulation, they are very crucial. India's RERA, Real Estate Regulation Authority, which we have discussed earlier also, was designed partly based on understanding of the market inefficiencies. And then valuation practice, these theories enhances appraisal methodologies, making them more accurate and reliable. Then we have unique characteristics of real estate markets. So, it is fundamentally different from other asset classes like stocks or bonds. So, let us walk through 5 key differences that make real estate unique. We have seen these. So, basically I will quickly talk about it. So, for example, heterogeneity, each flat is different, your real estate is different from another. In the same building, we have seen that at the same floor, 2 flats, one is facing sea, other is not. So, there is a clear difference in their price and the whole view about them. So, heterogeneity, then illiquidity. Real estate markets are not as liquid as your equity markets. And then we have information asymmetry, that is the information is more available with developers, the regular players, and in comparison to somebody who is coming for the first time in investing for living or for the first purchase, real estate purchase. And then we have segmentation, that is there is a drastic variation between local market, example Mumbai versus tier 2 city like Lucknow. So, there is this segmentation, and also the supply elasticity, that is long development cycles and complex regulatory approval. So, example land use conversion, environmental clearances will take time, and there can be implications for this. So, we will now look at the implications of these for the pricing theories. So, we have traditional financial theories require modification for the Indian context. We have market efficiency is often limited, and price discovery mechanism operates differently, often influenced by the local brokers and the sentiment. Then we come to efficient market hypothesis. So, efficient market hypothesis is fundamental to modern finance theory. It comes in 3 forms, each with different implications for real estate investing. So, weak form efficiency suggests that prices reflect all historical price information. In Indian real estate, this means that technical analysis is based on past price trends shouldn't consistently yield abnormal return. However, we do see some momentum effects during high growth phases. Then we have semi-strong form efficiency. So, which means price reflect all publicly available information. In India, this includes data from various websites, infrastructure development like metro lines and economic data. The challenge is that information dissemination can be slow and uneven across Indian cities. Then we have strong form efficiency, that means price reflect all publicly available information. In India, this include data from RERA websites, infrastructure developments like new metro lines and economic data. The challenge is that information dissemination can be slow and uneven across Indian cities, right. So, basically you can have semi-structured form efficiency, which is there that it is slow and uneven across Indian cities. For strong form efficiency, it will mean price reflect all information including private or inside information, and this is rarely achieved in Indian real estate because access to private information about future zoning changes or infrastructure project can lead to significant advantages. So, we have different forms, and understanding these forms can help you evaluate market opportunities and develop appropriate strategies. So, we have weak form efficiency, prices reflect all historical price information. We have semi-strong, which is price reflect all publicly available information, and strong form price reflect all information including private insider information, which might not be the case in Indian real estate, because we have seen that access to private information about future zoning changes or infrastructure projects can lead to significant advantages. So, that is there. Then we have the application of the efficient market hypothesis. So, here we can see that we have real estate which faces unique challenges in achieving market efficiency. So, if we break this down into structural barriers and information processing issues. So, structural barriers will be, there will be high transaction costs. We have seen that stamp duty and registration fees in India can range from 5 to 10% of the property value. That is a significant transaction cost. Then we have long transaction periods. The process form agreements to sale can take several months. We have limited arbitrage opportunities. Short selling a property is practically impossible, that you can do in stock market, sell your stocks and then buy them back. So, that kind of possibility of arbitrage is not possible. Moreover, arbitrage opportunity also goes down when you have such high transaction cost. And then financing constraints are also there, that loan to value ratio and lending standards by RBI and banks very stringent. So, that kind of constraints are also there. Then information processing issues. So, we have data availability, lack of centralized reliable transaction database, though this is improving, but still it is far away from perfect. Then we have information quality. Historically, a significant portion of transactions involve an undeclared cash components distorting official price data. So, there is information quality is also missing. And then professional intermediaries, brokers and appraisers have a strong influence on price negotiation. So, that is also there. These are the processing issues. So, the efficient market hypothesis challenges that how much actually it can be actually apply, how much it actually applies in real estate in India. That is a big question, or in general also that is a question. Then evidence for and against efficient market hypothesis in Indian real estate. So, supporting evidence. So, first we have this random walk behavior. Post RERA, major urban markets are showing more unpredictable price movement based on fundamentals, that we have all observed, that urban markets are showing more unpredictable price movements based on fundamentals, and then we have professional performance. Few real estate funds consistently outperform the market indices over the long term. So, if we compare with the market indices, we will see that the real estate funds are not consistently outperforming them. So, occasionally if they are outperforming and few times they are going down. So, that is not against efficient market hypothesis. And then we have contradictory evidences. Contradictory evidences would be predictable patterns, momentum and mean reversion has been observed, especially during the boom of 2005 to 2008 and the subsequent stagnation. So, we have witnessed that there was a boom period and then there was a subsequent stagnation, and we have been seeing these cyclical movements in a predictable kind of fashion, that a lot of mirroring of the past events we have seen in the form of the market cycles. And then we have seasonal effects. We have festival seasons like Diwali, often seen a spike in transaction and promotional offers. And then we have insider information. The value of knowing about unannounced government policies or project remains very high in this sector, and that is why there is a imbalance in the information availability between the developers and the people who are aware of this area and in general people. So, there are both supporting and contradictory evidences here. Then we have market implication, market efficiency implication for investors. So, we have active versus passive management, right. So, inefficient market like India's, active management and on the ground due diligence can yield superior returns. So, the more and more active management would be required if we consider that it is not an efficient market and the efficient market hypothesis does not apply, then in that case we will have to acknowledge that more and more active management would be required to go through this kind of market which has so much volatility, and that will ultimately yield superior returns. Then we have information advantage. So, local knowledge and strong professional networks are invaluable. So, that will influence our investment strategy. And then we have timing strategies. So, market inefficiencies create potential opportunities for well-informed investors. That we have to see that whenever these market inefficiencies are there, it will create potential opportunities for investors who are well informed about that the upcoming market events, or they can predict or analyze the market correctly. Then in that case there is a timing strategies option available for them. And then diversification benefits. So, real estate offer diversification from more efficient markets like stocks. So, there we can see that also. So, there is lot of diversification benefit which are available. And then we have practical applications of this. So, due diligence, we have to properly do the title searches that the ownership and the ownership records are very clear. We are clear about that, because that can be difficult in a opaque market like India, where the records are still not very digitalized. And then verification of building approvals also, which is something similar, that you have to be clear that all the approvals are there and they have been in the records, not just are looking at photocopies or all that. It should be proven through proper checks and balances. And then legal checks, which are critical, that there are no cases or anything, any dispute on that particular property. And then market research, you have to understand the local micro market trend. So, just understanding the overall trend will not be enough. You will have to be aware of what is going on in that micro market. So, micro market awareness is also very much required. And then we have technology adoption. So, prop tech platforms are improving data access and decision making. So, that also should be there, that you should use more and more these technologies, because they will help in taking the right decisions and moving forward in a proper systematic fashion. So, then we come to fundamental pricing theories. So, there we have the location theory. So, location theory based on von Thunen model suggests that property value is determined by accessibility to economic hubs. So, in modern India, this explains the high premium for properties in South Mumbai or near tech parks in Bangalore. The development of metro network is actively reshaping pricing gradients in city like Delhi and Hyderabad. And then we have hedonic pricing models, which treats a property value as the sum of its attributes. So, in India, Key attributes include location, size, amenities like power backup and security, and builder reputation, and even sometimes the Vastu compliance. So, the formula here would be your P is equal to F L S A Q N, where P is equal to price, L is your location, S is size, and A is age, Q is quality, and N is neighborhood. And then we have capitalization of income theory, which values property based on the present value of future income streams. The formula is value is equal to net operating income divided by capitalization rate. This is crucial for commercial properties, and in India residential rental yields are generally low, 2 to 4%, but capital appreciation is the primary driver of the return. Then we move to rational pricing in real estate. So, rational pricing assumes that market participants make logical decision based on available information. So, in practice we use several methods to determine the fundamental value. We have cash flow analysis, which calculates the present value of expected rental income. This is straightforward in theory, but challenging in practice due to India's low rental yield. Then we have comparable sales, which calculates the present value of expected rental income. This is straightforward in theory. We have seen the cash flow, present value of expected rental income. We have seen that it is challenging in practice due to India's low rental yield. Then we come to comparable sales, which is most common method for residential valuation. We have discussed that in past, that basically how the comparable of comparable sales or comparable valuation actually works is basically you find something which is very similar to your own property, and then you try to value your property by looking at the past transaction of similar property, and then you also make some adjustments, and we have seen that how this adjustments takes place, and overall then using this process you try to find out the valuation of your own property. So, this kind of process we have seen earlier, and basically mostly you will see that it is followed in residential properties. Then we have another approach which we have seen, that is your cost approach, where we have seen that replacement cost minus depreciation plus land value, often used for unique properties or for insurance purposes. So, when the properties are unique, when properties are like villa or some heritage building, then in that case cost approach might work. The comparable or income approach will not work. And we have then economic fundamentals. So, that will also be influencing the value, and that is your GDP growth. The overall country growth is reflected through GDP growth, and then job creation in the service sector, because in India, if you take for example the job creation in the service, we are basically the middle class is mostly in the service sector, and service sector jobs are keenly inspected and analyzed, because that impacts the real estate market, because the key demand drivers are coming from the middle class in India, urban middle class, and they are mostly employed in service sector. And then interest rate, which are set by the RBI, are the key drivers. So, RBI policy is very much discussed and waited for, because that impacts the EMIs and the overall economy of the country. Then we go to price stickiness in real estate market. So, we have first this definition. So, price stickiness is very prominent feature of the Indian real estate market. It refers to tendency of prices, especially on the downside, to adjust slowly to changes in the market fundamental. So, search and matching cost contribute to this stickiness. The property search process is extensive and fragmented, and professional fees can be high and unregulated. Then we have anchoring and psychological factors are particularly strong in India. Seller often anchor their asking price to peak price seen in the past or what their neighbor sold for. Even if market conditions have changed, there is also loss aversion, a cultural reluctance to sell for less than the purchase price, leading to holding period instead of booking losses. So, we have seen that there are two issues. One is your anchoring, this is your reference price bias and the loss aversion. So, you have seen that somebody told you that in your neighborhood that this is what the price at which a particular property was sold, and because as there is no transparent open market where just like equity where your shares are sold in front of the world, there is a fixed price mechanism which is followed, and the prices are continuously updated as per the buyer and seller demand. There is no transparent mechanism to actually evaluate the price which is there for a particular property, and so a lot depends on the kind of sentiment which is there in that area. So, if you have heard from somebody whom you know that they have sold a particular property at this price, say for example X, and this happened around 1 year back or 1.5 year back before COVID, it was an office property, and now after 1.5 year of the COVID, it is a period where work from home has started, and you have office building in the same office in the same building. You will think that I will also get the same amount. That will be delusional, because you know that you should understand that a lot has changed since those that period, where now you see that more and more people are going for work from home. But you will keep on keep that reference as your price, and you will not move forward. So, that kind of problem. And then also at what price you have bought a particular property. So, you do not want to sell it below that, even though the market maybe there has been some infrastructure development which has worked contrary to your maybe your hotel. There has been a flyover which has led traffic away from that property which you own, and so basically that kind of thing has happened, but you are still not factoring in that, because you have you have a bias that whatever price you have paid, you do not want to go below that, even though there will be a time loss and you are sitting on your property, and you are, if that was for investment, you have lost an opportunity. So, that kind of biases are there. Then that causes price stickiness, and then we have institutional and market factors. So, that include historical use of undeclared wealth, which creates a price floor disconnect from fundamentals. So, change in bank lending standards can quickly freeze or unfreeze market activity. So, many properties are held by families with low or no debt, allowing them to wait out market downturn without being forced to sell. So, this stickiness creates both opportunities and challenges for the investors. So, implication of price stickiness. So, price stickiness dynamics include delayed adjustments. Price reacts very slowly to economic shocks. When downturn occur, transaction volume plummets first, while price remains stubbornly high for extended period. So, this leads to inventory accumulation with developer during slow periods. Then investment implications are significant. Slow adjustment can create market timing opportunities for patient investor. However, liquidity risk is substantial. Exiting an investment can be very difficult and time consuming in a down market. There is also the valuation challenge because quoted price may not reflect the true achievable market price. And then understanding the price stickiness helps you anticipate market behavior and position your investment accordingly. So, it also explains why real estate cycle tend to be longer and more drawn out than the cycle in the other investments we have seen. So that is there, and we have to understand that issue. So, it also explains why real estate cycle tend to be longer and more drawn out than cycle in other asset classes. We have discussed that before. And so, that is the implications of price stickiness. Then understanding the speculative bubbles. Now, a speculative bubble occurs when asset prices rise substantially above their fundamental values, driven by euphoric investor sentiment rather than the economic fundamentals. So, in past we have seen different asset bubbles and market bubbles, mostly the bubbles of economic bubbles of we always remember is like the most common talked about is your .com bubble that was around year 2000, when the new IT companies were coming up, and there was lot of confidence in that field, and without any due diligence also, just with those companies who had .com in them, people used to buy their shares for any prices, and that was not just the case in India, but throughout the world. And ultimately, when that bubble burst, there was actually very disastrous consequences for that to investors and also to the overall market. So, these type of bubbles on time to time do forms in economy, and real estate is also not aloof from that. So, what are the bubble characteristics? So, there is a rapid price appreciation, unsustainable growth rates are there. The price zooms at astronomical levels, and then we have disconnect from fundamentals, prices dealing from rental yields and affordability, widespread participation, broad-based investor and speculator involvement. So, more and more investors are investing, and there is a speculator involvement also, because people are now thinking that they can quickly buy and sell a property and immediately gain a lot. So, everybody is very confident, and they are not even thinking, not even doing proper analysis, and just because of the momentum they start participating. Then leverage amplification, because people are advised that you can take loan and amplify your returns. So, they more and more people will take loan and buy properties so that they can sell out and quickly gain from it. So, excessive borrowing to purchase assets will happen. This we have seen in the 2008 recession. So, that time a major reason for the real estate market dynamics which were there in US at that time. So, we have seen that during those days, and so excessive borrowing to purchase assets, and then euphoric sentiment, that is over optimism, and this time it is different narrative, that this time it is different, and the logic and the basic of business which have to be followed, the basic of economics which have to be followed are then kept aside, because people assume that this is not the regular times, this is something which has to be celebrated, and this will remain for a long period of time, because something significantly different is happening at this moment. So, there is a euphoric sentiment also which is continuously pumping this bubble. Then historically, we should remember that in Japan there was a real estate bubble in 1980s to 1991, and the timeline was 86 to 1991. Peak Tokyo land prices increased tenfold in 5 years. Loss, there was this causes of loose monetary policy and rampant speculation, and collapse, a lost decade with 70% price decline. So, after that there was a significant price decline which happened, and also at that for a very long period there was no much activity there. So, that kind of subsequent impact is felt. And then we have case 2 of US subprime crisis, which I was discussing, that around 2007 to 2008 we saw that there was this recession which started because of the US real estate market. So, that was known as your US subprime crisis. Causes were subprime lending, lax regulation, complex financial products such as MBS, CDOs, etc. And then this collapse led to 2008 global financial crisis, which impacted India's IT and export sector, causing a ripple effect in its real estate market also. So, when a bubble actually burst, and it burst in a developed country such as USA or maybe a Japan, then the impact is felt throughout the world. So, that kind of thing happened in US subprime crisis also, that when it started in US, the whole world was impacted by it. Then we also have Indian real estate boom period, that was for 2005 to 2008. Property prices in city like Gurgaon and Mumbai doubled or even tripled in short period. And the cause was that at that time GDP growth was around 9%, and there was rising incomes, opening up of FDI in real estate, and easy availability of housing loan. So, this is the period when things were moving very, very fast in terms of prices and the kind of demand which was being seen at that time. And then it led to collapse and correction, and the 2008 global financial crisis act as the trigger, a credit crunch, and the stock market crash also was there, and slowdown in hiring led to sharp price correction and long period of stagnation. And after that we saw that there was basically for a very long period there was not much appreciation seen in the real estate prices in most parts of India. So, bubble formation mechanism, we have to understand this. So, in this basically we have fundamental change. So, a new policy or economic condition. So, in India 2005 this was allowing foreign direct investment into the construction sector. So, the first thing which happens is that there is a fundamental change in the market, something new has happened. For example, we talked about dot-com bubble. So, the advent of IT industry, IT related field was opened up, and people started talking about the potential of how the world will change with the internet and everything. So, that is how that stories actually fill up the narrative and make more rosier picture than what you can imagine, and that is how the process starts. Then we have credit creation and leverage. So, easy credits, bank aggressively pushed home loans with attractive initial rates. Speculation entry, a large number of investors enter the market purely for short term capital gain, not for self use. So, you make a quick calculation in your mind that I can take debt from bank or from some housing loan company, and then I can go and purchase this property, and with this percentage of stamp duty and registration cost which I will be paying as transaction cost, this is the overall cost I will be bearing, and in 6 months my prices will zoom from this level to this level, and then I can quickly sell it, and I can make this kind of profit. So, that kind of calculation starts going in people's mind, and so easy credit and speculation entry both are taking place during the phase 2. And then we have euphoria and mania. So, herd behavior, basically fear of missing out, FOMO factor comes in here, and that drove many first time buyers and speculators into the market. So, that is how the phase 3 will take place. and media amplification will also there will be continuously positive news that will come in the media, and that will also encourage more and more people to come and invest in this. Then phase 4 will be critical stage and collapse. So here the 2000 global financial crisis case comes in, that that and subsequent liquidity crisis which happened. So there is something, there is some mega event which has happened, and that will lead to the collapse of this bubble. The bubble will burst, and immediately there will be repercussions of that. So for this particular boom which we saw in India, the trigger event was this 2008 global financial crisis. It happened there, but it impacted the bubble in India also. And the deleveraging forces selling by over leverage investors and developer, because you are already at a leverage position and you have to pay for your interest, and so the whole calculation actually loses sense. So immediately the first one who will be selling is the one who is holding that property with the help of a leverage position or some debt position. So they will be the one who will be selling it first, because first of all their idea was short term, and secondly they are holding it because of the help of some loan or some other arrangement. So they will not want to constantly keep paying this interest. So they will try to come out of it. So that once that will start, it will start impacting others also. So the whole chain will start in the opposite direction now, and then price collapse will ultimately happen, because at throwaway prices they will start selling because they want to cut short their losses. So that is how the whole bubble will happen. So identifying bubble condition is important. So we have price to income ratios. When property prices grow much faster than average income, so that is your the first indication. Then price to rent ratios, rental yield are extremely low rental yields. Example would be below 2%, can signal overvaluation. And then there will be credit growth, a rapid expansion of mortgage debts. So there will be more and more people are going for taking loan, so that they can purchase and quickly become part of this the whole process. And then a rising inventory of unsold homes will be there. Unsold inventory will keep on piling. So even though you are looking at prices growing faster, but at the same time you are looking also at the unsold inventory, so there will be some kind of mismatch also. And then qualitative indicators. So media coverage, there will be widespread euphoric media reports about the real estate boom. Everyone will be talking about it. There is famous saying that when the people start talking on the street, it is time to come out of that investment. That when you meet general people in bus and other places, and they start talking to you about the investments, which is not the general topic of discussion, then in that case it is time to get alert. And then popular participation. This is your they have never invested and they have started talking. And then lending standards. So bank offering loans with little due diligence. Example, 90 to 100% financing. So banks will also start cashing in on this, and they will also bring in with with the low little due diligence. So they will also start coming in this area with more and more more and more financing and less due diligence. And then behavioral factors in bubble formation. So confirmation bias, seeking information that confirms the belief that property prices only go up. So you will try to seek only those sources which will confirm your bias. Then availability heuristics, overweight weighing recent memories of rapid prices. So you will remember only those cases. And then anchoring bias, getting anchored to high asking price. That is what we discussed earlier also. And of course, during these times, there is a overconfidence. So overestimating. And then social dynamics will be herding behavior, a powerful force in the Indian investment landscape, that there you will see that many people are doing the same thing. And then social proof will be there, that buying a property in project because many others are buying it. So these kind of social dynamics will takes place. And then market anomalies and inefficiencies. So common in real estate market such as momentum effect. Strong price trend often continues for a short to medium term, especially in a bull market. Then mean reversion will take place. Prices will eventually revert to their long-term trend line as seen in the long stagnation post the 2008 boom. So for a longer period of time, there was no movement, right? So that kind of stagnation, mean reversion will take place. And then seasonal patterns, you have festive season premiums. So developers will launch new projects and offer around Diwali and Akshaya Tritiya. You will have, these are the situations where you very well know that will happen. And then monsoon run is there, that activity often slows down during the heavy monsoon period. And we have geographical arbitrage, price differences, significant price differences for similar properties across different neighborhood of the same city or even on different sides of a major road. So geographical arbitrage is also there. So there are certain market anomalies and inefficiencies which a keen observer can definitely take advantage of. So momentum effect, mean reversion, can be there. And then we have seasonal patterns. We have seen in festive season demand, monsoon, there is no sale. Then geographical arbitrage, some, similar properties across different neighborhoods that have different price tag. So all these, inefficiencies, anomalies can be used for the advantage. Then we have risk management and how we can prevent bubbles. So fundamental analysis, focus on rental yield and long-term affordability, that will be there. This is for your individual strategy. And then diversification, avoid concentration all your wealth in a single property or city. Conservative leverage, do not over leverage, maintain a healthy equity cushion. So you should do not exceed, excessively use leverage. That you should always keep in mind. Only when you are comfortable that in case of difficult situations also you will be able to bear it, then only you should go for it. Otherwise, for speculation, we should avoid leverage. And then contrarian approach, be skeptical when everyone is euphoric. So when everyone is euphoric, there is this continuous, talk about price appreciation. Everybody on street start talking about investment, then you get alert. So that is something which you can do at your individual level. Then we are talking about institutional responses. So regulatory oversight, RERA for transparency and accountability, these kind of approaches will be there. Then monetary policy, RBI will and of course it will become active through interest rates and loan to value ratio limits to control credit flow. And then market surveillance, so monitoring credit growth and price ratios to identify systematic risks. So SEBI will come into picture and they will start regulating more keenly these areas. Then we come to contemporary challenge and future direction in India. So we have technology, we have PropTech, the rise of platforms like Magic Break, Housing.com and No Broker is increasing transparency. So these are, bringing more and more clarity to this area. Regulation is there, RERA, GST, they have fundamentally changed market and made it more transparent. Then urbanization and demographics, rapid urbanization we can witness. So these are some contemporary events we can see. And then the government initiatives, the housing for all, PMAY, that is Pradhan Mantri Awas Yojana, and the smart city missions are reshaping the supply and credit, creating new investment corridors. So these are the government initiatives which are there. And sustainability is also playing a crucial role now. So whether it is ESG or whether it is green building through LEED certified building. So these all these are things which are observable in market. And then research frontier, so we have behavioral economics, studying the psychology of the Indian property buyers. and big data and AI using data analytics for more accurate property valuation and trend prediction. So, we can see all this happening and future also we will see that they will continuously move towards these directions. So, in conclusion, if we say that their market efficiency, Indian real estate market are largely inefficient, but gradually improving due to technology and regulation. We have pricing theories, we have location, hedonic and income models are all applicable, but must be adapted to local Indian context. Then we have price stickiness. So, a key feature of the Indian market is driven by this price stickiness, driven by psychological and structural factors. So, we have understood that how and why price sticks in India. So, we have discussed that there are certain biases, whether it is your anchoring bias or whether it is your referencing bias. So, basically all these type of bias are playing a key role in price stickiness in India. And then we have speculative bubbles. We have discussed that the real estate is also impacted by speculative bubbles and how it is something which can be seen beforehand by certain actions which is happening in market, and at an individual level and at an institutional level, what kind of steps you can take to safeguard yourself or improve the situation for institution for the overall betterment. And then practical application. So, informed decision making, understanding these theories is crucial for making sound investment decisions. So, earlier also we discussed that there is a quantitative way to look at the issue of real estate and also qualitative way to look at. So, this particular lecture we have tried to see that how emotions play a key role in the price transaction and how the overall bubble formation takes place in real estate. So, psychology is also very crucial when it comes to the decisions such as buying and selling in real estate. And then we have risk assessment. So, recognizing the signs of a bubble can help investor avoid costly mistakes. And then we have future consideration. So, we have technology and transparency. The dual impact of PropTech and RERA will continue to make market more efficient and transparent. And affordable housing, this segment will likely be key driver of growth in India. So, that is something which we should keep in mind, that affordable housing and all these are upcoming sectors and they are here to stay. And with the government help and incentivization for this sector, a lot of growth is possible in this area. So, some questions for further reflections. How is RERA changing the level of market efficiency in Indian real estate? What role does black money or the informal economy still plays in real estate pricing in India, if any? So, that is something which you can check and think about. How can an investor use the concept of price stickiness to their advantage in the Indian market? We have learned the concept, but how you can use this for your own advantage. And then what technological developments, AI, blockchain, do you think will have the biggest impact on the Indian real estate market in the next decade? And how do state level differences in stamp duty and regulation affect real estate pricing and investment decisions across India? So, these are some questions which you should think about and finally take proper decision if you are going for an investment, and also that will enhance your knowledge and overall understanding of what we have discussed today. So, thank you so much.